Real estate did not stop working this year. That's the claim that's going around right now, and it's absolutely wrong. What's actually happened is that bad financing is getting exposed. So I'm going to show you a deal that did everything right, hit every number that investors dream about, and still lost $15 million. Then I'm going to show you why and make sure this never happens to you. Before we get into it, do me a favor. If you're new here, hit like, subscribe, and tap that notification bell. I put out real estate content 3 times a week, built for people who want straight answers, no BS, and no hype. I'm Bud Evans. I did 35 years in the United States Air Force, 13 years as a police officer. I later served as the mayor of Sentiments in New Jersey. Today, I'm an active real estate investor across 4 states on single-family and small multifamily properties. I mentor veterans and first responders breaking into real estate, and I founded a low-cost, investor-focused property management company. Here's a belief that's spreading right now across real estate YouTube. This is why our video is titled, Why Real Estate Investing No Longer Works in 2026. That video argues the old buy and hold playbook is dead. Rates are stuck near 6.5%. Cash flow is thin. Appreciation is not bailing out mediocre deals the way it did from 2012 to 2021. The message lands with a lot of people because it feels true. Payments are higher, margins are tighter, and it's harder to make a deal pencil out than it was 5 years ago. Look, I understand why that video got traction and 20,000 views. But here's the problem. It blames the market for something that was actually an underwriting and financial decision problem. And I can prove it with one story that broke big in the investing community this year. Brandon Turner is a great person. I've met him a couple of times. He's a wonderful guy. If you have spent any time in this space, you know who Brandon Turner is. He's the former host of the Bigger Pockets podcast. He's the author of some of the most read real estate books in the industry. One of the most recognized faces in modern real estate. In late 2021, Brandon's fund, Open Door Capital, partnered with Disrupt Equity to buy a 387-unit complex near Houston, Texas, called Heights on Katy. The purchase price with closing costs came to about $72 million. They took out a loan of roughly $52 million and raised about $25 million from investors. On paper, it was a textbook value-add deal. A-class property, below market rents, real upside, renovate the units, raise the rents, improve operations, refinance, and sell in 4 to 5 years. Great. And they executed. They did everything they said they were going to do. Over 4 years, annual rents grew from $5.9 million to $7.8 million. That's a 33% increase. Net operating income, or NOI, improved from $2.3 million to $3.6 million. Occupancy stayed right above 90% the entire time. By every operational measure, you can put that on a spreadsheet. This deal was working. And they did their job. They did it perfectly. What killed it? Financing. The loan was a commercial adjustable rate note with a 4-year term, not a 30-year fix like most of you are used to seeing on a single-family rental. From day one, there was a clock running on that deal. Then when the Fed started raising rates aggressively in 22, that clock, it sped up fast. Payments jumped, insurance spiked because Gulf Coast hurricane risks. Property taxes followed. Cap rates shifted, which dropped the value of the property on paper, even though it was outperforming. Refinancing, which had always been the exit plan, became close to impossible without bringing a mountain of new cash to the table. They fought for it. Brandon says they tried multiple refinancing paths. They did a capital call back to investors, and he personally refinanced his own house and put every dollar he had into the deal. He relocated to Texas for 6 months to be closer to the problem. They raised about $4 million in new commitments. It was still not enough. Rates moved again before they could even close a refinance. And the deal they thought they had locked in fell apart. At that point, they needed $14 million to refinance and were still $10 million short. Selling became the only option left. The best offer on the table was about $62 million. That covered the loan balance with $10 million left over, but that was $15 million short of what was owed out to investors. So here's where it gets specific, and this matters. Not every investor in this deal lost money. A conservative Class A investor, the one who accepted a lower return in exchange for being paid back first, they got their principal back in full. The Class B investors, the one who took on more risk, chasing a higher return, they lost everything. About 150 investors averaging about $100,000 each. They watched their principal go to zero. Now here's the whole reason that I wanted to bring this to you instead of just another rate update. Brandon did not go quietly. I got to respect the guy. He posted about this publicly in his own words with no filter. He said, quote, "They did not follow the economy into this deal. They followed me. They are not experts. I am. I chose to buy. I chose the market. I chose the timing, and I let them down." End quote. That is rare in this industry, guys. Most operators go silent when a deal fails. Brandon leaned in, he took the hit publicly and turned it into a lesson for everybody who's watching. I give him full credit for that. It takes a lot more discipline and a lot more extreme ownership to own public failure than it does to post another win. If you're a veteran and you're watching this and you want a community of people who talk about this stuff, deal structure, financing risk, what actually happened on deals like this one, go check out the War Room with David Perret. There's a link in the description. It's built specifically for veterans getting into real estate, and it's a resource. It's not a sales pitch. If you want one-on-one coaching from me instead, you can find that at budevans.com, and there's a link in the description as well. But the War Room is where I want you to start if you're a veteran. So let's get into the system, because the lesson here is not don't invest in real estate. The lesson here is don't let financing be an afterthought. Operations got this deal an A. Financing gave it an F. Most investors spend all their energy on offense, finding the deal, running the numbers, projecting the upside. That's important, but almost nobody spends real time figuring out what's going to happen if the market changes before their loan comes due. That is defense, and defense wins championships. It's what keeps you in this business for 30 years instead of 5. So here's the breakdown on how you can protect yourself. First, know your financing structure cold. Is it fixed? Is it adjustable? What's the term? Do you have a balloon payment? A BRRRR you haven't refinanced yet? A short-term hard money loan on a flip that hasn't sold? Or a short-term rental portfolio that depends on occupancy staying high? You're carrying the same risk that Brandon's deal carried, just at a smaller scale. Second, stop treating well-known names or a big social media following as due diligence. Brandon built a real brand and helped a lot of people, and that's true. But content, skill, and risk management skill are 2 different skills. Before you put money into any deal, know who you're in with, who the operator is, and what financing looks like, what the exit plan is, and what happens if that exit plan fails. Third, watch for what's called yield sickness. That's when investors go focused on chasing the highest possible return that they normalize taking on excessive risk to get there. In the Heights on Katy deal, the investors who took the safer, lower return got their money back. The ones chasing the bigger upside, they were the ones left holding the bag. High returns come with higher fragility and higher risk. That's not a flaw in the system. That's the deal you're making, whether you realize it or not. Fourth, get comfortable with long-term fixed rate debt whenever you can get it. A property with long-term fixed financing can survive a bad market because time is on their side and you're hedged against inflation. A property with short-term adjustable financing, you can get forced into a sale at the worst possible time, even if the operations behind it are excellent. The financing really determines how much time you have to survive a downturn. That's the whole game here. Build in reserves and slow down your pace when the market starts to get uncertain. They're not the ones who scaled the fastest. They're the ones who knew when to protect what they already built. It's not exciting content. It doesn't get the same views as buy 10 doors this year, but it is the difference between investors who are still standing in 2030 and investors who won't be. Let's bring this back to Chandler's video because I want to be fair to the argument. He is right that the environment has changed. Rates are higher. Margins are tighter. The easy money era where any deal worked because appreciation covered your mistakes, that's gone. That era is over. But that does not mean that real estate stopped working. It doesn't. It means that real estate stopped forgiving bad financing. The deals that are struggling right now, they're the ones that you bought with short-term debt, thin reserves, and a bet that rates would come back down to 4. The deals underwritten conservatively with long-term fixed financing and real reserves, as they're still cash flowing and they're still building wealth. Same market, completely different outcome. That's not luck. That's just discipline. All right, before we wrap up, as always, here's your recap checklist. Use this as a gut check on your own portfolio or on your next deal. Number 1, know the exact terms of every loan you carry, fixed or adjustable, and know the maturity date. Ask yourself right now, what happens if you can't refinance for the next 3 years? Don't let an operator's reputation or a social media following replace your own due diligence on any deal that you invest in. Next, watch for yield sickness in yourself. Chasing the highest return is not the same as making the smartest decision. Next, prioritize long-term fixed rate financing whenever it's available to you. Build real cash reserves instead of counting on appreciation or a future refinance to bail you out. Then, slow your growth pace when conditions are uncertain online. And when things go wrong, take the Brandon Turner approach. Own it. Communicate with the people who trusted you and turn the mistake into a lesson instead of hiding from it. Real estate still works, guys. I'm still buying. It always has. What stopped working is buying deals like it's the 2021 market. It's not 2021 anymore. Get your financing right. Everything else in this business gets a heck of a lot more forgiving. If this helped you out, do me a favor, hit the like and subscribe, hit that notification bell, and share this with your friends so you don't miss the next video. I put these out 3 times a week. Thanks for watching. I'm Bud Evans. Aim high, execute fast. I'll see you on the next one.